respected resource person, CA and all-rounder Divya Abhishek, and Secretary C. Anirban Pal, my dear MC members, and past chairman of the branch, senior professional colleagues, ladies and gentlemen, I welcome you and a very good evening to all of you. So today, as you know that today is very important aspect we are going to discuss. For every audit of companies, there are specific guidelines, specific standards are there. But regarding the audit of these non-company entities, so far that everybody is doing their audit of the companies, there are so many doubts under what laws they are doing. Is it under company law? Is it under Partnership Act? Or is it under Reserve Bank of India Act for bankers? Or what under what law we are doing it? So many doubts are there. And in these circumstances, because there are so many doubts because the financial statements prepared on CS, whether on their own letterhead or auditing standards applicable to proprietorship and partnership also, or notes to accounts prepared in case of audit of non-companies. So, in these circumstances, our Institute of Chartered Accountants of India that has given the recently a book is released and accounting standards for non-company entities always takes necessary initiative to ensure effective and consistent application of these standards. For the purpose of applicability of accounting standards of non-company entities, scheme for classification of non-company entities into 4 levels, that is level 1, level 2, level 3 and level 4 was prescribed by our ICA. Level 1 entities are large size entities and required to comply with all the standards. Level 4, level 3 and level 2 non-company entities are considered as micro, medium and small size non-company entities and have been granted certain exemptions, relaxations. Moving forward in this direction, further strengthening and standardizing this financial reporting system of these entities, the Accounting Standards Board of ICA has issued a technical guide on financial statements of non-corporate entities. Because there are so many doubts on this topic, so we requested Divya madam. So she has kindly consented to deliberate on this topic today, because this is very, very important, because many of the business firms are either proprietorships or partnerships or Hindu undivided families or LLPs like that. So on this topic, we request Divya madam to deliberate thoroughly on this, because to acquaint so much knowledge to take up the audits of non-company audits effectively. In this direction, before going for this subject, now I request Anwar Sridhar Garu, please introduce today's resource persons, CA Divya Abhishek.
Good evening, dear members. CA Divya Abhishek is a practicing chartered accountant in Chennai. She has held various qualifications: BCom, FCA, ACS, CMA, LLB, Audit from UK, and Diploma in IFRS, as big as her name alphabets. And she is a fellow member of the ICA and associate member of the ICSI, and she is a qualified CMA, having passed her final examination conducted by the ICMA recently. She is a graduate in law, and she had secured All India 46th rank in CA final examinations and All India 23rd rank in the CS examinations, and she also secured All India 4th rank in the International Taxation examinations conducted by the CIOT. She has qualified in the proficiency test for the independent directors conducted by the Indian Institute of Corporate Affairs. CA Divya Abhishek has completed her diploma in IFRS with Association of Chartered Certified Accountants UK and advanced diploma in international taxation with Chartered Institute of Taxation UK, and has obtained her certificate from the International Tax Laws and Transfer Pricing from Leiden University, Netherlands International Tax Center under the guidance of the world-renowned Professor Kees van Rad. She also attended special sessions at Harvard University and is the youngest professional to reach this milestone. She had completed her basic education from Vidya Mandir, Chennai, where she was a constant school topper right up to her 12th standard. And she was adjudged as the best student from amongst the students of Vidya Mandir School. She did her articleship from E&Y in the Audit and Assurance Department. After qualifying as CA, she continued to work with E&Y in Audit and Assurance Division, and she had audited and consulted for various listed companies, MNCs, public companies, private companies, and other forms of organizations, including HNIs. She also been selected to a team constituted by E&Y as a special task force to deal with the Impact of Companies Act, which also involved presentation and discussion at various MNCs. CA Divya is a prolific speaker, and she had addressed over 800 conferences, seminars, and workshops organized by various entities. She has co-authored a book on the income tax reference, which is being well accepted in the professional and academic circles. She had held various positions in the SIRC of the ICAI since 2015-16 till 2021-22. She also held various prominent positions in several organizations such as the Council of Zambia in South India, and the Federation of Indian Chamber of Commerce Industry, and Inner Wheels of the Rotary Club of Chennai, and so on. And so she had various, so many positions she had held in various prestigious organizations. She is very passionate about the profession. She is a firm advocate of the principle of giving back to society, which she has imbibed from childhood, and as the president of the Inner Wheel Club of Madras, Next Gen played a pivotal role in the upliftment of and education of the underprivileged girl children. She spares no efforts to curb the dropout of girl children in corporation schools and enthusiasts them to pursue further education. She is also actively involved in career counseling for rural women, and she organizes awareness programs and fundraising programs for women self-help groups to help them in sustaining independently by funding their projects. CA Divya Abhishek is a passionate women social activist with focus on women empowerment. With these few words, I introduce the speaker to the August Gallery. Over to the speaker.
Thank you, Sridhar sir, for a very humbling and detailed introduction.
No, yes,
my regards to Vasudev Murthy sir. In fact, what can be said in 2 hours, he has given a succinct talk within just 2 minutes. That is the kind of quality and potential that Vasudev Murthy sir has. It is always a privilege and honor for me to address in Visakhapatnam branch. I also give my regards to the past chairman, Murli Krishnan sir, and the secretary. A very good evening to one and all present here. I'll just quickly share my slide to dive right into the session for today. I hope it's visible, sir. Okay.
Yeah.
So the topic for today, practical issues in auditing of non-company entities. Now, friends, generally as chartered accountants, we assume we are under the notion that accounting standards is usually only for large entities. This is not something that we need to be worried about for smaller no tax audit assessees, for individual assessees, and we just can go about with our day-to-day operations. And that is where, friends, today's topic takes paramount importance, because increasingly there is a large focus that has been kept on non-company entities. So whether you are auditing Mukesh Ambani Reliance, or whether you're auditing your street vendor, a tea shop vendor at the end of your street, today you need to take cognizance of accounting standards. The reason is bifold. First and foremost, there is a quality review board that has been constituted. Friends, this is not new. You might wonder, accounting has something changed in accounting standards? The answer is no. Has something changed in the CA profession? Absolutely not. Both remain the same, but what has changed is the regulatory and statutory environment in which we function today. Increasingly, quality review board that has been constituted last 18 months, if you see the trajectory, the kind of cases that they're picking up are no longer restricted to large companies. Earlier, there was a benchmark to pick out large companies, companies in which public were interested. Only those accounts on the basis of turnover was being picked up and reviewed by the quality review board. But today, the institute has gone bifold. The reasons we will understand over the course of our session, but increasingly, accounts are being picked up at random to check if compliance has been made correctly. Secondly, there was a notification on March 20th, 2021 released by our institute, where for the first time, retrospective effect has been given, where the applicability of accounting standards for non-company entities took some reference. So the numbers speak for themselves, friends. If you take Form 3CA as of Jan 2021, usually entities which are required to be audited under a statute as per provisions of Section 44AB need to file Form 3CA. All the other entities which do not require an audit, let us take an example. If you are an LLP, if you have more than 40 lakh as your turnover, an audit is mandatory. Therefore, if you are liable for tax audit, you need to file Form 3CA. All the other entities that need not go through an auditing process, most of your non-company entities will fall into this bucket of Form 3CB, where the turnover has exceeded the tax audit limit, but there is no audit required. Now, if you see the numbers, Form 3CA only 2,80,000 as compared to Form 3CB, which is 25 lakhs, almost 12 times the number of 3C entities are under 3CB. Straight away, you can say 3CB entities are non-company entities because auditing is mandated for all companies, whether 1 rupee or 10 rupee turnover. The next aspect, increasingly what the government took into cognizance is 96% of entities in India earn less than 250 crores. Not only that, the kind of risk profile and exposure that the banking sector takes, where individually, if a bank is lending to one tea shop vendor, the risk is not high. But the same bank lending to 20 such vendors, the risk profile is very high. Therefore, it was deemed fit that the focus has to be on the non-company entities. Now, I keep mentioning this word non-company. What are non-company entities? All that you see in the bucket, whether you're a sole proprietor, partner firm, AOP, society, all entities that are not incorporated as a company fall into this non-company entities. So generally, the perception is these are small entities. Now, that's where I want to correct you, my friends. If you take Airport Authority of India, it handles all the flights across India. It is a non-company entity. If you take LIC, recently, it went for IPO. That is a non-company entity. So what is interesting to notice, all non-company entities are not necessarily small entities. All entities that are guided by a different statute, whether it is going to be partnership, LLP, or whatever it is, it falls under this bucket, which means, interestingly, the same accounting standards that you use to prepare this tea shop vendors accounts, you'll also be seeing LIC using it and larger entities using that. Which brings us to the next question. Whether an LLP falls into a company or a non-company. You can take from the definition, friends, where Section 3 clearly defines LLC as a body corporate formed and incorporated under this Act. So now when you see the word body corporate, automatically it gets tagged with the corporate entity, which is also why if you read the words of this notification, all this while ICAI mentioned as non-corporate entities, today it is mentioned as non-company entity. Automatically, LLP comes into this banner of non-company entity. Whatever we are discussing today also becomes applicable to LLP. Earlier, before March 2021, this was not the scenario. Also, as an interesting development, the government and the MCA have come out and said they're trying to bring out specific standards under the LLP Act itself Now, just like how in the Companies Act 2013, you have section 133, which prescribes accounting standard for companies, the LLP Act is also developing a specific set of regulatory standards to the LLP. In which scenario, when the standards get notified in the next few months, it has gone for the President's asset. When it gets notified, at which point LLP will be out of this bracket. So now, friends, we have understood what a non-company entity is, which brings us to the next logical question. What do we have to do with it? Now, I am filing income tax return of a small person, of a teacher, only salary income. I am filing it as a small business, a roadside shop, which doesn't have too many transactions. Do you mean to say I need to follow everything? I need to follow accounting standards. Where does it say for my 2000 rupee fee, should I be looking into all sorts of complaints and disclosures? That is where I want to draw your attention, friends, into three different buckets. The first bucket is those non-company entities which are liable for tax audit. Where does it say, as a tax auditor, I need to follow accounting standards? Now, we are all aware, when we do the tax audit, we are bound by the Income Tax Act, which clearly mentions you need to follow ICDS. Where does it say Indian accounting standards need to be followed? The answer is in the question itself. If you look at your 44AB, the Form 3CB or 3CA report, there are 5 points that we need to certify. Normally, we just certify one line true and correct and we proceed with the 3CB. Friends, no longer you can do that. With the kind of regulatory aspects that are coming into play, you need to read these reports and specifically mention various aspects. To bring to the question of where it mandates accounting standard is the guidance note issued by the ICAI in January 1994, where it clearly says, when you certify anything to be true and fair or true and correct, it is presumed that the financial statements are prepared in accordance with accounting standards. So this fifth point that you see here, in our opinion, it is true and correct. When you say it is true and correct, you are certifying as a chartered accountant that they have also followed the necessary accounting standards. Now, the next question comes, when you issue the audit report of a company, you issue your financial statements, you issue notes to accounts. Where in this certificate, when I say true and correct, do I mention the accounting standards? Ideally, friends, in this point 3, we also have to upload the various accounting standard disclosures along with your certificate where you're saying it is true and correct. So it has become clear that for all companies which fall into this bandit of tax audit, we need to have a following the accounting standards, which brings us to the next question. For those companies, most of my clients, they are non-company entities. Their turnover has not touched this 10 crore limit. They still go through a regular return filing only. In such case also, do we need to file a tax audit report? Now, let's take a simple scenario. That person for the shop account person comes to you and he says, sir, I need to take a loan from the bank. They're just asking you to give the last 3 years balance sheet of my books to see my credit worthiness. Now, not just bank, anywhere they take loan from, this is going to be the next question. Now, in such a scenario, as an auditor, you just need to give a signature, sir. Nothing else, don't worry. Friends, the minute you put the paper to the pen, the minute you discharge an attest function, as a member of the institute, you are implying that the accounting standards have been complied with. So this has also been given way back in 1979 in the preface to the Statement of Accounting Standards. Now let's come to the last scenario. Nobody has asked for your attestation. You are not filing anybody's tax audit report. Now in such a case also, do we need to follow accounting standard? Where is it said? The answer is yes, friends. Again, when I first started, I said, by very virtue of you being an member of the Institute of Chartered Accountants of India, you have to automatically follow the accounting standards. It is said very clearly in our Code of Ethics in clause 6, where it says, material misstatement known to him to appear in the financial statements. Now, in order to understand what is a material misstatement, we have to go to our SA 320, the auditing standards by which we are bound by, where it says any financial reporting framework should include accounting standards, and non-compliance with accounting standards is a material misstatement. Therefore, whether you are filing your tax audit report, whether you are giving a attesting function or whether you are just doing your work, you need to ensure that accounting standards have been complied with. A next question that comes, friends, all these years you have been enrolled to the institute, so naturally you are bound by this code of conduct, but you have not followed the accounting standards. What is to be done? Are there any repercussions? The good news here is these standards for non-company entities has been evolving over time. It first came out in 2003, then in 2008, then 2013, and finally in 2022. So over this period, the extent of grip that the institute also has on the review function has increased. As I already said, there is a specific quality review board that picks up smaller entities which are either filing the tax audit report or filing just a return and starts reviewing. Now, during that period of time, if it is reviewed that as a CA, you have done a work towards that account and not followed accounting standards, then you become liable, friends, to disciplinary proceedings. And it is not a small punishment. They can impose penalty up to rupees 5 lakhs and also remove you permanently from the register of members. And in reality, the last few years, increasingly, we find a lot of disciplinary action being taken in this regard. Having understood the implications and requirement for us to understand the importance of these accounting standards, the next aspect is going to be the practical applicability of it. Now, before we delve into that, if we quickly look at what is on the screen, this is the balance sheet. We're all used to a Schedule 3 format, and this is a T-shaped balance sheet. A lot of questions that come typically from my team is, can we continue to follow this? Because accounting standards become applicable, should we just follow same as what we do for companies? Again, this is that, friends, we need to have a clear distinction between a company and a non-company entity. There is nowhere required that you need to follow a Schedule 3 balance sheet or any specific format. But what you do need to take cognizance of is the substance over form, which is the accounting standard which determines the manner in which you provide a balance sheet. For example, Accounting Standard 5 indirectly provides you a format in which your P&L account and your balance sheet is to be prepared, where you need to clearly mention what comes from ordinary activities, what is an extraordinary activity, disclosures, prior period, so on and so forth. Also here, friends, I notice in a lot of smaller accounts, the P&L account is very large, which is where we need to go back to the accounting standard and understand only those expenses whose nature is different and the amount is material. The word is and. So only both these conditions are satisfied, you can show that line item separately in your P&L account. Otherwise, you need to consolidate and show it together as one head of expenditure only. The next aspect, now that we have understood what is the format, whether we need to show prior year comparative figures, the answer is again yes, friends. This has also been given the guidance note and the clarifications issued by the institute, where it says even for a non-company entity, we need to show the prior year and current year comparisons. So this format that you see here is incorrect because you do not have the previous year figure comparison shown. So whether you are doing a small partnership firm or a sole proprietor, you have to take cognizance of the representation of your balance sheet. This brings us to the next aspect of the session, where we have understood that why accounting standards are taking paramount importance. Now, for that small fee that I'm charging to just file a salary return, do I need to issue a report with disclosures and so on and so forth, a heavy booklet? Practically, that will not make sense to me. And this concern is very valid, which is also being addressed, which brings us to the part of the session where we are going to understand what are the different accounting standards that are applicable, what is mandatory, and what is the leeway given by the institute. Before we delve into that, let us understand how this came about. Now, as I already said, Accounting Standard Board has been there for 43 years. So over a period of time, they've been issuing different circulars and notifications through which it became applicable for non-company entities. But for the first time, a big step has been taken by the institute, where they came out with a notification in March 2021, and made it applicable for that year itself. So the first year in which this notification becomes applicable is 31st March 2021, and 31st March 2022 will be your second year of applicability of these provisions. And why is it important? Is because they have extended certain limits for in line with your government MSME standards to enable some harmonization in the manner in which your accounts are being prepared. A lot of CAs, when this notification came out, felt it is too much work. By making us follow accounting standard, it does not make financial sense also in terms of what you charge the client and what work you're doing. I want to stop that thought there. Please remember, friends, we do not need any professional indemnity insurance. What is our insurance in the profession is these accounting standards. By mandating the necessary accounting standards to the client, you preparing any attestation or any work for them also relieves you of that much risk, ensuring that the accounting standard has been duly followed. There are three different sets of accounting standards. One is your Ind AS. Now we are all aware Ind AS is for large entities which have net worth greater than 250 crores, or your banking and insurance companies with more than 500 crores. So automatically for those entities which follow Ind AS, this accounting standard for non-company entities become inapplicable. The second is the accounting standard notified by the MCA. Now earlier it used to be the 2006 accounting standards. Today it is your Companies Act 2021, on the basis of which company accounts are being prepared. The last aspect are going to be the accounting standard issued by the ICAI. So all your entities other than your company will come into this bucket, which is bound by the notifications and circulars issued by the ICAI directly. While for the company you go to MCA, for non-company it is the ICAI, that is the Framework Setting Authority. What has changed? For the first time they brought one more level. Now all these years there were only 3 levels. We will be going through these levels, but they've got one other level to give substantial relief to the smallest entities in terms of compliance, but at the same time have upheld the basic standards that are mandatorily required to be complied. Now, what are these levels? If you see, the 4 levels are large, medium, small, and micro. And there has been a huge shift because earlier, before 2021, it used to be limited to 50 crores. Any entities that has turnover more than 50 crores automatically becomes a large entity. As if it is a company, you will need to audit the entity. But now this has been increased 5-fold or to 250 crores, where your largest entity has a turnover of more than 250 crores and borrowing more than 50 crores. Now, friends, these might just be looking like numbers to you, but there is a logic to it. Every level, if you divide by 5, for example, it's 250 crores, 50 crores, 10 crores, and less than 10 crores. And the borrowing also you can divide by 5, 10 by 2, 10 by 5, 2 crores, 50 by 5, 10 crores, 50 crores, and 50 more than 50 crores. So as you can see, the basis in which this revision has been made is in line with the MSME definition that the government revised on 1st July 2020. So you might ask me, what is the difference? Why are we having one other classification as large, medium, small, micro, and why is it not just the MSME classification given by the government? Now the reason is, when the MSME classification came out, they looked at 2 aspects. One is turnover, second is investment in plant and machinery. Now, while the institute felt fit to have the turnover criteria, because it is an easy criteria to distinguish entities by, they replaced this investment in plant and machinery with borrowings. And the reason being, when you take plant and machinery, there was multitude of confusion. What comprises plant and machinery? What is the investment in it? Whether I take only additions or the total investments, and how to go on with it. So largely they have harmonized the provisions to keep it easy for the companies and the non-company entities, with just a minimal differentiation between the two. When we look at these numbers, which year should we take? If we are auditing for March 31st, 2022, you need to look at the year immediately preceding 2022, which will be 31st March 2021 numbers. Secondly, there are 2 criteria. One is turnover or borrowings. So when you look at borrowings, whether you will take borrowings as on the previous year, just like how you look at turnover, or how does one go about it? There is a small catch here, where while for turnover, you look at the end of the year turnover. If it is borrowing, you need to check at any time during the preceding year, whatever was the highest borrowing, that is the borrowing you will consider for this limit. Now, why was this done? The answer was simple, friends. It was increasingly noticed that many entities had large borrowings, but suddenly on 31st March, there was a huge repayment. And again on April, the borrowings increased. So it was starting to note that there's a lot of planning involved in order to avoid to jumping to the next level for complaints. Entities were starting to make differential borrowing rates as at the end of the year. So please keep in mind, these are important criteria for us to assess why, which level an entity has to get into, and why I will take you through based on the exemptions and disclosure requirements given through these notifications. Your level 1 is called your large entity. The reason we will not be discussing level 1 is whatever you do for a company becomes applicable for a level 1 entity. There is no exemptions, no disclosure requirements. Everything that you do for a company, you need to have a disclosure. What comes under level 1 will be those companies which are getting listed or already listed, banks, financial institutions which do not follow Ind AS, and obviously the parameters of turnover and borrowing. So a lot of times a question evolves, what actually comes into that? Which non-company entity is going to go list in the stock exchange? Which comes back to our first discussion, whether you're a real estate investment trust or a infrastructure investment trust, your State Bank of India. So all these will come into this. Take the latest case of LIC. It went into listing. So all of that will be considered as a level 1 entity. Believe me, friends, level 1 entities are much larger than the public companies that you see that are getting listed on stock exchange. Then the next is your level 2, level 3, and level 4. There were 2 criteria. One was turnover. When you determine the turnover, you do not include this other income or the GST portion of it. That is some relief given. When you look at the borrowings for these entities, borrowing from anybody, it is not just restricted to bank borrowings. Even if you have borrowed from the partner of the company or anybody, in such scenario, that borrowing limit has to be looked into. Which brings us to the next question. What about for a charitable trust? Now, you may be aware, charitable trust is either registered as a society or is formed as a trust through a trust deed. Automatically, since it's not registered as a company, it falls into the bucket of a non-company entity. While we go through these standards of non-company entity, most charitable trusts are below 10 crore, but there are also larger trusts. So whether these charitable trusts also need to follow accounting standards, what is the relief given? Because we may be seeing charitable trusts where you prepare receipt and income statement, which is not your typical profit and loss or balance sheet. So automatically it's going to violate your AS4 that we just went through. That is where we need to look at the notification very clearly. The start of the notification says any entity engaged in commercial, industrial, or business. So automatically, when it's a charitable trust, it is not going to be engaged in any of these aspects. Therefore, we can conclude that a charitable trust is not get covering under this non-company entity and need not follow accounting standards. But there are 2 aspects that you need to keep in mind in order to completely exclude the trust that you are auditing. The first aspect is, let us take a scenario where it is a hospital that is being run as a charitable trust. Everything is free for the patients. But the hospital has a pharmacy through this trust, or the hospital is suddenly charging for some oxygen cylinder or beds because of scarcity. In all these scenarios, it automatically takes the color of a commercial transaction. Therefore, even if there is 1 rupee that becomes commercial or a business transaction, then it becomes a non-company entity, and all accounting standards that will apply to the levels of the non-company entity will become applicable to the trust also. So increasingly, what is advised is, if any trust is doing anything commercially that takes the color of it, immediately form a separate entity so that more clarity is given when you're closing the audit for those entities. The second aspect that you need to be aware is these trusts, sometimes when they have excess funds, they will put that into fixed deposit and earn an interest from these aspects. Whether that will be considered as a commercial entity, if so, the answer is largely no, friends. There are multiple case laws which aid that and say it is only a secondary income. It is not the primary commercial activity income, but a secondary income, and you can still claim exemptions from the same. Now, because these differences have been introduced in the levels, and for the first time they've introduced the micro level, what is noticed is a lot of entities that are earlier classified as a level 1 entity became a level 2 entity because direct drop. Earlier it used to be 50 crores, the government increased it to 250 crores. So automatically many entities will fall below the bucket of the 250 crore limit. It is a beneficial aspect where the institute has clarified and said, so in 2020, if you form part of level 1 entity, you would have had to disclose everything as per accounting standards. But today you became a level 2 entity, you do not have to worry. You can go with what is applicable for level 2 entity as long as you make a mention in the notes. Now let's take the converse, where a level 1 entity ceases to be covered under level 1 and becomes a level 2 entity. Now in this scenario, for minimum 2 years, you should continue to disclose as if you are a level 1 entity. The reason why this was given was, friends, it was felt that some companies might have a minor dip in their values, which cannot be a permanent aspect. So in order to not confuse the readers of the financial statements to have different disclosure aspects, a 2-year continuity period has been provided. Over and above this, the level in which this non-company entity falls has to be specifically mentioned in your notes to accounts. You need to mention that which level it is followed and what are the exemptions and disclosure exceptions that you are taking. We keep mentioning based on the level, your criteria of what applies to a non-company entity changes. So this slide summarizes that, where, as you can see, everything that is in green is a direct applicability, which means accounting standard 1 to accounting standard 12 is going to be largely applicable for all entities. Whether you have a 1 rupee turnover or whether you have a 20 crore turnover, it is going to become applicable except for your cash flow statement, which certain exemption has been provided. Now, in this bucket of 1 to 12, friends, it is important for us to understand the repercussions of it. The reason why it becomes globally applicable is these are bedrock of accounting standards. So even if you do a very small account, you will notice that these standards largely become applicable to even make those accounts to file your tax return. If you see in this table, there are certain disclosure exemptions that are given. What are these disclosure exemptions and what are the other exemptions? If you see after accounting standard 12, the other standards, for example, segment reporting is not applicable for your level 2, level 3, level 4. Related party is not applicable for level 3, 4. So like that, there is a deviation method in which the non-applicability has come into picture. And these also, there is some logic. For example, if you take earning per share AS20, it is not going to be applicable at all. The reason is because when you're a company, you have share capital, but a non-company entity typically does not have any share capital. But it still features as a non-applicable standard because if you take a society that has a share capital aspect and they need not go and follow your EPS standard. Similarly, interim financial reporting, joint venture, associated enterprise, all of these standards are given certain exemptions from. If we summarize what becomes applicable and non-applicable, you notice a large part of standards, 11 standards, are non-applicable for your micro entities. And these 8 standards are typically your basic first 8 standards that are applicable. If you see level 2, which is the larger entity, only 16 standards are fully applicable. And level 3, where below 50 crore turnover, only if you know 12 accounting standards, it is enough. So logically, if we notice, these buckets that you see on the screen are not applicable for any of the levels. And also it makes the process easier. For example, earlier, when AS 17 was applicable for large entities or medium entities, it was found to be very difficult because they used to take geographic segmenting based on your GST registration. There's a lot of confusion on which to segregate where. So today there is no differentiation, there's no requirement for you to do a segment accounting. Friends, I'm not going to go into each accounting standard because I feel that is something we are all aware about. But we're going to look into practical applicability of how accounting standard comes into play when we look at a non-company entity. Now, many professionals, especially doctors or actors, follow cash system of accounting, including CS. We know that accounting standard 1 says accrual is one of the fundamental accounting assumptions, which means automatically it implies that you cannot follow cash system of accounting. But what happens? Now, all these years, for many non-company entities, many sole proprietors, we have been following cash system. So today we have become aware that accounting standard 1 is mandatory for anybody. So whether what we have prepared all this while, is it wrong? The answer is no. You need to go one step further and look. For now, for those for whom you've been doing cash system of accounting, you'll be filing the return through income tax. When you look at section 145 of the Income Tax Act, it allows you. It says you can either go through cash or accrual method. Further, the minute you do cash system of accounting, ICDS will not become applicable to you. So while what you have filed and the manner of accounting you've done is correct, you have not followed what is required from your accounting standard 1. So it is important that for all those entities for whom you are following cash system of accounting, you have to ensure a note goes in with either your 3CD or when you're filing just the return as an annexure to the balance sheet, where you specifically mentioned that cash system of accounting is followed and this note that I've indicated below forms part of your audit that you do for your non-company entity. Generally, when we look at AS1, it is felt as if it is a detailed disclosure standard. Always, we actually need to split our notes to accounts into 3 parts. Your part 1 has about the business, what that person is doing. Part B has accounting policies that is being followed. And part C actually has the notes to the balance sheet. So please remember, the contingent liability numbers or statutory provision numbers that we give should form part only of part C. Part B should only have what are the standards applicable, what you are doing. And this is required even for a non-company entity. They have emphasized enough the reason why this is required. Let's take another scenario. You're changing the method of depreciation. Now, friends, while for companies, this is a one-off instance where after many years they decide to change. If you see these non-company entities, they wish to always explore and see if they can just change their method of depreciation from SLM to WDV in order to see how that business is doing better or worse. Whether when there is a change in depreciation, we need to report anywhere in the audit report or notes to accounts. There also we need to be abreast, friends, where in 2017, ICAI in para 63 clearly said, change in method of depreciation is only a change in estimate and you need not do it retrospectively. Therefore, AS1 mentions if there is a change in estimate, there is no requirement for you to mention it. Only when there is a change in accounting policy, you need to mention in your notes to accounts. Let's take another common aspect that we do in our non-company entities. If you take depreciation, whether the number of years of useful life of the asset, we follow as per your Income Tax Act itself, or whether we should do the Schedule 2. Now, straight away, we all know Schedule 2 is for Companies Act. So your depreciation can never take the rates as given in Companies Act. So most of us, what we do, whatever depreciation that we put in P&L as per income tax, same depreciation we take, so that there's no further hindrance. There's no requirement for us to give adjustment as per income tax, as per books, when we file for smaller entities. Friends, please remember that is not the correct practice. Accounting standard very clearly says the manner in which you need to depreciate your assets. When income tax looks at depreciation of assets, it looks at a block of asset concept. But when you do any books of accounts for non-companies, you need to look at the individual asset and determine the useful life. Largely, this might not be questioned, but practically, if you have a very specific asset, especially in these small startups, there are very specific software, very specific assets that have come. So please ensure that you collect a management representation letter where they determine that to be the useful value, especially if you have a high value asset in the books of accounts. Let's take a scenario of AS2. We always say it is lower of cost or net realizable value. That is wrong. It is lower of cost and net realizable value, which is a very important determinant of your inventory. Whether small, large, small shop, retail, whatever it is, every year mandatorily this is required to be done. There is increasingly a misunderstanding that when we do AS2, you can either do FIFO or weighted average method, whichever you can choose. Friends, that is wrong. Please remember, when the value of your stock is on an increasing trend, you will follow only your FIFO method. When it is fluctuating, you are not sure of the direction of the trend of stock value, then you follow weighted average method. This is very, very clearly given in the standards, which is why I reiterate, the first 12 standards are very important for every CA to be aware, because on that basis only you need to prepare any books of accounts. Even if you have 20 rupees stock, you need to still do lower of cost or net realizable value. You need to still determine the method in which you value the stock that you are using. Over and above this, there are disclosure exemptions given in that first 12 standards. For example, in AS10, you need not disclose what assets that you have retired from active use, what you have not held for sale. What is this? Now, AS10 is applicable. The manner in which you value your asset, everything you need to go as per AS10. But usually there is a requirement to disclose in the notes to accounts where you will say, this asset is fully depreciated, but I'm still using it in the factory. Or you have to say, this asset is not depreciated fully, but I'm not using it actively. So all these extra disclosures are done away with for all level 3 and level 4 entities, so that it is not cumbersome. For that little fee you collect, you are not spending time on these additional aspects. If you take AS11, you need not disclose the foreign risk management policy. Does that mean AS11 is not applicable? No. You have to still follow AS11. When will you follow? If there is an export order, if your company is importing, or if they're trading overseas, AS11 becomes applicable. But you need not go to the notes to accounts and do a detailed policy that you're using for your foreign currency risk management. Similarly, in AS26 also, certain disclosure exemptions are provided where you need not show the impairment loss that you've recognized, or if any asset that you've fully depreciated but still using, you need not worry. From experience, friends, usually AS26 does not become applicable to non-company entities unless it is a software entity, in which case you need to ensure that you depreciate your asset within 10 years. But otherwise, these standards are more for technical theory aspect for us to understand and evaluate. One aspect that is increasingly taken precedence is when you look at the case, especially during the period of Corona and after, some companies wonder, Madam, I had shut the factory for 3 months. No, none of the machinery were being used. So during that period, can I avoid the depreciation charge for the 3 months so that my P&L looks healthier? You need to go back to the accounting standard, which says, in order to arrive at this depreciation, already wear and tear, efflux of time, technological obsolescence has been taken into account. So at no point of time can you avoid charging depreciation because the machinery was not put to use during that period. So these kind of creative accounting practices cannot be resorted to for any of the entities. There are further disclosure exemptions given to level 2, level 3, and level 4. One is your investment, where you specific statute you do not need a disclosure. If you take AS29, there is a requirement where any provision you create, you need to show opening, current year, and closing. In reality, we might not follow this, but all these are not required to be done for these smaller entities. The next aspect where significant relief has been provided in AS15. I know a lot of us, the minute we hear AS15, we are a little unsure of the standard itself. That is the kind of quality the standard has had on us. where I wanted to simplify and spend a little time to tell you what you need to take into account when you're auditing a smaller entity as against a large entity. Now, AS15 talks about all your compensation that you give to your employees. We're going to talk about two specific aspects. One is going to be your leave encashment, and the other is going to be gratuity. Now, when you look at leave encashment, friends, there are different practices that firms follow. For example, they allow you to take 10 days leave in a year. After that, it lapses. Some firms say you're allowed 10 days leave. If you don't take it this year, don't worry. Next year, you can carry forward the 5 days leave and you can take the same leave. Some firms go one step ahead and say it's a leave encashment policy of the firm where you take 10 days leave. You do not take, don't worry. You can accumulate till you retire. And at the end of your retirement, you can withdraw that amount equal to compensation equal to the number of days of leave. Now, while these are employee-friendly policies, they call for a lot of complications when we look at accounting. So when you look at compensated absences, two things are classified. One is accumulating, other is non-accumulating. What is non-accumulating? The minute the firm says you can take 10 days leave or it is over. Next year you get new fresh 10 days. It's a short-term aspect, not accumulated. Nothing needs to be worried about. The next aspect is accumulating. Now, in accumulating, there are two different aspects. You take 10 days leave, but if you do not avail the full 10 days, you can carry forward 5 days leave. So many times what happens is, say you are paid for 300 days in a year, excluding holidays and all of that. You actually work for 310 days, you get the same salary, 1,20,000. Now, in the next year, you decide, I'm going to take my 10-day eligibility plus another 10 days of last year. So you work for 290 days and you still get the same 1,20,000 salary. So these aspects are called non-vesting, where there is no aspect of finances involved, but you get to carry forward or subtract the number of days of leave. Now, these non-vesting are two aspects. One is short-term, where you say only up to 1 year you can carry forward, otherwise it's gone. Long-term, where you say till you retire, you can keep carrying forward 10 days leave every year. Now, this other long-term non-vesting requires an actuarial valuation mandatorily. The second aspect, where you don't say you carry forward the leave, but the firm commits and says, don't worry, if you don't take so many days leave, you get paid at the time of retirement the equivalent amount. Now, automatically, this comes under the bucket of vesting. Friends, please remember, anything as a policy that is allowed to be carried forward long-term in nature becomes liable for actuarial valuation. In reality, a lot of non-company entities have these kind of creative leave structures, but are not following the requirement of actuarial valuation. One safety is provided where they've said, if you have employed less than 50 people, then for non-vesting aspects, that is for level 1, level 2, level 3, and level 4, it is not applicable. Also, another good news is for level 4 entities, you don't even have to think about actuarial valuation. Very logical. My turnover is less than 10 crores. I cannot go pay an actuary 1 lakh to get a valuation done because I have a good leave policy. Now, similarly, when it comes to gratuity or pension, there are two kinds of post-employment benefit. One is your defined contribution plan, which is your PF, PSA, monthly you make a payment, done away with. Second is a defined benefit plan. Friends, the minute you have 20 employees, it is mandatory for you to go with the provisions of gratuity. The only relief that the institute has provided is for level 4, it is not applicable. If you are level 2 and level 3 and you have less than 50 employees, don't worry. But the minute you have more than 50 employees in that year, you have to mandatorily get an actuarial valuation. Now, you might ask me, all these years, I had more than 50 employees. I'm a small entity, partnership firm, but doing very well. More than 10 crore turnover. I've never obtained actuarial valuation. What is to happen? There is nowhere I've been questioned. Let's take a simple example. A partnership firm is taking a group LIC policy. It is complying with gratuity. taking an LIC policy where it is making payment. Whether that firm has to get an actual valuation, answer is yes. The reason is because the minute you give that payment to LIC, tomorrow, if the funds are short, LIC can come back to you and recover your dues when a top employee resigns from the firm. So for those who do not follow this actual valuation, you need to qualify the audit report mandatorily to save yourself. And also when this quality review comes, specifically you need to mention that actual valuation is not done. The best way where you can do that is in your tax audit report for those entities that fall above the limit we discussed, for whom actual valuation is not done, it needs to mandatorily be disclosed. The other standards such as your 23, 25, 27, which pertain to your joint venture, interim financial statements, they become applicable only when there is a requirement to do so. What do I mean by that? If you are a partnership firm, you own a building with one other partnership firm. Many family entities have this structure where there is a joint control over an asset. In such a scenario, you need to follow your AS25 for joint venture partnership. Now, similarly, if you are a small person, a sole proprietor, and suddenly you request your auditor to give you a 6-month financial because you want to go take a loan, in such a scenario, your interim standard for interim financial statements become applicable. So these are just staggered exemptions given, but in reality, when there is a requirement, the standards become applicable. Which brings us to the last part, which is going to be your level 4 exemptions. Now, level 4 we know is your micro entity. It is a new level created by the government for turnover up to 10 crores and borrowing up to 2 crores. Certain more exemptions are given in terms of AS28, AS27, AS14, amalgamation, impairment accounting, and your joint operations. The critical relief given to this aspect is your AS22, which talks about taxes. Now, while the entire AS22 is not exempt, the aspect of deferred tax is completely exempt for your level 4 entities, where there is no requirement for you to compute deferred tax for any of the level 4 entities. But friends, there is one catch here. If you decide to go through this provision and not take your deferred tax, the day that entity crosses that level 4 and becomes a level 3 entity, your deferred tax has to be adjusted as if for all these years it was being computed into your reserves as a transitional requirement. So what is advised is, if you are doing a non-company entity and you feel in the next 2 or 3 years it is going to anyway make that leap from level 4 to level 3, in such a scenario, you please advise your clients to voluntarily comply with deferred tax so that at one day when they cross that, it's not a root shot. There are many firms, including professionals like us, where we know that the chances of crossing that 10 crore might be a long shot, at which scenario it is good to avail this benefit of not complying with your deferred taxes. So we have understood the importance of these implications, the requirement to follow accounting standards. More importantly, between the 4 levels, what are the different standards that become applicable? Now, the one practical aspect that we need to think about, before which I wanted to tell you a little joke that I got reminded. Now, the auto driver and priest died and went to heaven. On the gates of heaven, the Lord is there who's evaluating everybody. When it came to the priest, he said, "You've done great service for the last 40 years. I'm very happy with your contribution. You preached my name and spread a lot of goodwill. So in appreciation of that, I'm going to give you a 1-bedroom apartment with bathroom." The priest is very happy. The Lord says, "You please wait. Go in with the next person." The next he calls the auto driver. The auto driver comes. The Lord says, "I'm extremely unhappy and disappointed with you. You are a drunkard. Not only were you drunk, but what you did, you also took people in an auto every day by risking everybody's life in that process. However, I give you one bungalow apartment with 4 beds, attached bathroom, swimming pool, and 2 attendants." Now the priest heard this and he was very annoyed. He said, "My Lord, what have you done? You said that he was a drunkard. I preach your name." At which time the Lord said, "My son, efforts are very important. But what is more important is the results of these efforts. Those 40 years when you were preaching, everybody was sleeping. The 40 years that the auto driver was driving, everybody was praying. So that comes to this, where efforts have been taken, friends, by the institute to institute these accounting standards, to bring out these levels. But what are the results of it? And that proof is in the pudding itself, where we need to understand practically how these standards have impacted, what are the different changes that have come out while the course of our tax audit. The first amendment that has taken a huge precedence in the last 1 year is with respect to your employee contribution. Now, we are all aware, when we talk about employee contribution under section 43B, as long as you make contribution of PF or ESI through the employee and the employer before filing the return of income, you can claim that as a deduction. Now, you go to section 36(1)(5)(a), which specifically mentions, to the extent of employee contribution to Provident Fund, it has to be done prior to the date as provided by the statute. Now, always there's some confusion, friends. If I don't pay PF by 7th of next month, do I need to disallow? Or if I pay before filing my return, before September 30th, whether I can take the allowance. There's a lot of disputes. Different high courts took different views, which said 43B overrides, so on and so forth. But now the budget 2021 has clearly said, where they inserted a clause and said, in your 36(1)(5)(a), it is hereby clarified that the provisions of section 43B shall not apply and shall deem never to have been applied for the purpose of determining due date, which means 36(1)(5)(a) takes precedence. So all those companies which claimed employee contribution to employee by delayed before the 7th of next month but paid before return filing will now need to disallow. Friends, unmindfully, many of us still disclose these dates in 3CD under the necessary clause, but claim your deduction automatically next day, like a platter, this 143(1)(a) notice comes. So please keep in mind these contribution to Provident Fund and other statutory dues. If they delay beyond the date in which the statutory act requires to be deposited, it has to be disallowed. The second and interesting practical provision has been in this 269 SS series. Now we know that any person cannot accept loan or deposit otherwise than by way of account pay check for an amount of 20,000 or more. There was a real case law that happened where there was a worldwide township project. It was involved in real estate development. Now another entity, Centriflow, what it did, it purchased land for this worldwide township and passed over that land as a loan to worldwide township. So naturally, in worldwide township books, they passed an entry land to party as payable to that party. Now the income tax officer came out and said, you have violated 269 SS because you have accepted loan otherwise than by way of account pay check. What? You took the land and you credited the party, which becomes a loan that the party has given. So I'm going to disallow it. Friends, this was struck off, but a very similar case in Mumbai got upheld and 269 SS got triggered. Let us bring it to a very normal example you and I can understand as a chartered accountant. A partner goes to the airport, he wants to go abroad. He decides to purchase an iPad. For whatever reason, he forgot his credit card, he uses the firm's credit card. Now automatically, from the firm's angle, it is going to take it as a partner's drawings. In this case, the assessing officer is triggering 269T, where it says the firm is repaying money to the person from otherwise than whom it has borrowed. That is, by merely putting transfer entries between the partner and the firm, it has to be disclosed in 269T. This is a real requirement which has come through the guidance note. Multitudes of such practical aspects that we come through, which need to be reported diligently in your tax audit report. Another common scenario where your customer gives you an order, suddenly he decides to cancel the order. Now, whether you can continue to recognize that as inventory or whether you need to write off. ICI has given a very clear guidance which says all that inventory that is made specifically for an order which makes it unsaleable to other customers, you need to write off. Otherwise, you can continue to recognize that as an inventory in your books. Another scenario in AS2 is, as we already discussed, every inventory you need to recognize lower of cost and net realizable value. Friends, companies like Reliance, by following this, has disclosed a loss of 4,000 crore by just writing off this NRV. Similarly, if you have extra expenses to maintain your inventory, a lot of companies are loading on stock because they're not able to sell it at a fast pace owing to the corona lockdown, so on and so forth. You cannot capitalize those expenses. Very, very clearly, the manner in which your stock is being recognized has been clearly disclosed in your books of accounts. When we come to AS9, let's take a scenario where your client has done the work, but he is not sure of the collection from it, whether he needs to recognize it as revenue or not. The answer is simply no. AS9 does not deal with how much revenue you recognize, but it only deals with the timing in which you recognize the revenue. So unless you are completely certain that you're able to collect that amount from your customer, you need not recognize the same as revenue. Similarly, when you have sales returns, discounts, or damages, you cannot net it off against revenue. You have to net it off against revenue. You cannot go take it into your purchases account. A lot of companies, because they want to show a higher revenue, they show increased revenue and separately in P&L under purchases or consumption as a sale return, which cannot be done correctly. One disputed aspect that comes when we look at AS9 is in the area of services. Many non-company entities, which are service-oriented entities, tend to recognize or measure the service as per their option, either on completed service method or proportionate completion method. Friends, this is where again we need to go back to the standard. Every service has to be done only through a completed service recognition method. Only those professionals or service persons who have an ongoing contract can go through this proportionate completion method. Similarly, there are various standards where practically we can disseminate and understand the manner in which your AS takes precedence. For example, if you take AS 13, which deals with investments, it clearly says cost or NRV, whichever is lower for a current investment. Now, how does one determine whether it is a current investment or a long-term investment? Friends, there is a normal misconception where people think if an investment is there for less than 12 months, so after balance sheet date, it's a current investment. But that's where you need to go understand the objective of the standard, which very clearly says the intention of the entity at the time of making the investment, whether it was going to be a long-term investment or a short-term investment, is the basis on which you make the differentiation. How does it make a difference? If it is a long-term investment, you will only recognize it at cost. If it's a current investment, you will recognize it at cost or NRV, whichever is lower. So please remember, how do we as accountants determine the intention? You need to go into the resolutions, the discussions that the management had in order to segregate between your current and non-current. If we take a scenario of AS16, whether when there is a halt in production for whatever reason or asset construction, should we continue to capitalize this interest cost as required by AS16 or should you not? The answer is no. Capitalization of interest during the period of suspension or non-operation, it has to go into your profit and loss accounts. Now, all these aspects we will practically be dealing with, whether it is a small or large entity. So we need to take these standards into cognizance. One other very critical standard is your AS19, which talks about leases. Any entity, any professional, any proprietor, any business person will have something that they have taken on lease, whether it is going to be a machinery, whether it is going to be land or their office space. The one aspect that is getting missed out is this straight lining. What do I mean by straight line? Whenever you take an operating lease, that is lease for a shorter period of time, you need to follow AS19, which requires you to straight line. Let's take an example. I have taken an office space. I am a partner in a partnership firm. I have taken an office space in a good area where I'm paying rent. Now I enter into a deal with the landowner and say, first 12 months, I'll pay you 50,000. Next 12 months, there will be a rolling agreement, even though the rental agreement will be only for a period of 12 months. I'll pay you 60,000. So every year you have an escalation clause as required. Whenever you go through that for any entity, you need to multiply, say 5,000 into 12 plus 6,000 into 12, divide by 24. Every month you need to recognize 5,500 as an expense. Please remember, the straight lining is a correct indication of the lease rental and not just seeing the rental agreement, what is for that year, applying it, so on and so forth. The last aspect that I want to touch upon before we open out for question and answers is in the area of deferred tax. Friends, many startups, which are small entities, which fall into this typical bucket of non-company entities, what you will see is they'll be incurring loss on a year-on-year basis, but getting funded. Also, during the course of audit, some auditors feel, okay, it is going concern because people are funding into this entity. It's a good startup, proven. Otherwise, why will big entities put? So I'm going to recognize a deferred tax asset to the extent of loss. That is where we need to take cognizance of AS 22. Unless you are virtually certain that that entity will become profitable, you should not recognize deferred taxes for the accumulated losses. It is not just enough that it satisfies your going concern basis. It is equally important that it has to become profitable and you're virtually certain. How do you determine that? You need to delve into the plans of the company. You need to have documentation and the basis on which this deferred tax asset is created. A lot of people assume deferred tax is notional. It is a real asset, friends. It is only a differentiation between what you offer for profit as per books and taxes. It's a real asset. So anything that is created as a deferred tax asset, just because of the value and the manner in which it changes the presentation of the balance sheet, you need to ensure that it is being done correctly. The last, of course, is going to be the impairment. I'd already informed, for level 4 entities less than 10 crore need not worry about impairment. Certain exemptions given for level 2 and level 3. Usually, this impairment standard is not something we deal with, because unless there are impairment indicators, you do not have to look into impairment at all. Unfortunately, the situation we are all in, automatically these impairment indicators are triggered, which is economic performance, significant change, market change. Because of Corona, impairment indicators are present as of today, which pushes every auditor to look into this impairment section. The exemption given is, in order to impair an asset, usually the cash flow from that asset you feel is not adequate to the what you have invested as the cost of the asset, impairment comes in. How do you determine this? You take the original price at which you purchased the asset, and then you look at the net selling price or value in use. Now, for arriving at this value in use, friends, it's a very complicated process where you need to take next 5 years projections, discount it, arrive at a value in use. So logically, the institute has come out and said, don't worry, you do not need to work out this value in use for level 2 and level 3. Make a reasonable estimate, take your net realized value, and accordingly proceed with the impairment. So with that, friends, I will definitely share this presentation, which has various other indications, but I would also like to discuss and take questions. So in the looking at the time, I think I will end the session with this today. I once again want to thank Visakhapatnam branch for having me here. Thank you so much, sir. It's always a pleasure to address these bright members. And also in the process, I notice I always go back learning much more than what I came here with. Thank you once again. For any questions, please feel free to unmute or you can put in the chat box and I'm happy to answer them. Thank you, sir.
Members, please unmute yourself and ask questions or put it in chat box. Members, or you want any clarification?
Please elaborate applicability in reporting of TDS for first time audit under 44 AB. Sir, very valid question. TDS is a paramount provision because increasingly we see a lot of complaints aspects when it comes to non-payment of TDS on time. In 44 AB, there's a specific clause that requires you to disclose the TDS payments under various sections. There's a specific clause which again requires you to disclose what is the interest that you paid in case of late deduction or if there is a non-deduction. So definitely you will need to look into the expense ledger in full in order to determine if the client has been compliant with TDS. There is no shortcut around it because even when they take up for assessments under 142, this is a requirement that they routinely ask for all entities to give the TDS applicability.
Hello, Divya.
Yes, sir. Hello, sir.
In non-corporate entities, small firms like partnership and property concerns, they are not accepted the comparable figures. See, they thought that unnecessarily creates income tax issues as well as GST issues. Why? That's a problem in latest problems in one of this one. So what about our position? Whether we have to write a note or how to deal with that? Do you have any
Sir, I think that is where if supposing you are doing tax audit, then definitely make use of that 0.3 in your 3CB or 3CA report, where you can specifically mention that certain figures were non-comparable because of different stands taken. If supposing you are not doing tax audit, but just filing the return, it is always worthwhile for you to let the client know that accounting standards are mandatory, which means automatically you need to prepare notes to accounts and get that signed. Which is why I said this accounting standard applicable is actually a cushion for CAs like us. It's an insurance for us to ensure that if there is any mismatch or something that is beyond your control, you have it written from your end and you have it signed by the client also.
They said, see, if you go by partnership firms, in income tax form also there is no need of comparable figure. Then what is your equivalent? Why you are insisting for this all extra work? See, small firms, they don't have that much employees now.
I fully agree, sir. I understand the difficulty of it, but the institute has given a technical guidance for these non-company entities, which mandates you to have previous year figures also. So while you do not have to upload it when you put in the income tax return, it is still recommended that you have a hard copy for your records, because tomorrow if there is a review of any sort, you have the documentation as required as determined by the institute.
Okay. Thank you.
Members, any other questions are there? Please unmute yourself and ask questions. Because Divya madam has taken lot of pains and explained in detail, step by step. I think that's why you don't have any doubts.
I will also share the PPT with you, sir. So whoever requires, you can please circulate it also. Yes, sir.
Madam, if I may ask one question. That is, this technical guide has come up on the non-corporate entities for the preparation of financial statements. Now, I did not see a date mentioned there as to from which year it is applicable. See, it has come very recently, and for the financial year, if it is applicable for the financial year ending 22, then I think we have very little time to change, because all these years we have been used to taking out printouts from the tally and then submitting them for the individuals and partnership firms where there was no framework specified. Now we are looking at a framework which is almost akin to Schedule 3. Now, given the scenario, is there a specific time or a transition period allowed for the entities, or for the first year itself they will all be applicable?
Very good question, sir. And I think a lot of us have these questions. That's why actually, if you see, this was a landmark notification that came out. It came out in March 20th, 2021, where they've mandated these standards, different aspects. And they said, in fact, when it came out in 2021, it became applicable for 31/3/21 itself. And then subsequently, the institute has released a technical guidance. So the logical interpretation is it is applicable for 31/3/22. But I would also say that they're not going to mandate and require you to have every schedule. It is only a guidance that is given. So to the extent it is applicable for you, it is worthwhile to do for 31(3)22 itself, or ensure that 100% of it is done by 31(3)23. But as per law, it is required to be complied with, sir.
Madam, just a follow-up question to that is that with respect to these non-profit entities, because the types of transactions that happen for a non-profit entities, it is difficult to fit them into that Schedule 3 format that they have given. Although, you know, in the subschedules they have described that cost under cost of goods sold, what has to be given under, you know, revenues in terms of donations and all. But the other line items are almost, you know, akin to a manufacturing or a trading entity. While the line items for a non-corporate entity in terms of a non-profit organization would be very, very different. So can we, you know, alter the face of the balance sheet and the profit and loss account to fit in those proper line items so that the presentation is proper and, you know, more understandable? Because if I give this kind of set of financial statements for a non-profit entities or, you know, non-profit organizations, the first thing is the management is not used to this kind of format, neither are the other statutory bodies. They are used to looking at the persistent payments and income and expenditure financial statements for non-profit entities. Suddenly I give them a Schedule 3. So my doubt is whether we can change the line items within the face of the balance sheet and profit and loss so that they reflect the figures more appropriately and clearly to the stakeholders.
Sir, for non-profit entities, this notification is not applicable at all. So unless there is business, commercial or industrial activity, only in such scenario, this non-company entity classification becomes applicable. If that entire entity is only for non-profit charitable causes, then this requirement is not there. And to answer your question further, if there is commercial activity, then this becomes applicable. In which scenario you are allowed to tinker with the how you want to present it, because this is only a recommendation. It is not a mandate that has come out. Recommendatory in the manner in which they want you to prepare the accounts.
Right. Thank you so much.
Sir, are all the questions answered, sir?
Applicability of TDS for section 44 AD entities.
So the chat box, okay. So if TDS will become applicable even for 44 AD sections, sir, even if this section 194 AC, HJ, all of it becomes applicable. It is, in fact, 44 AD requires a whole new session. So you can always email me and I can give you the specific requirements for the same. I'll also type in my email ID in the chat box.
So this time we have to prepare Schedule 3 as separate book, I mean separate statement as well as like detailed statement for income tax purpose, right? Because Schedule 3 figures we have to prepare in roundings, right?
Sir, schedule, there is no requirement for round off, sir.
Yes, I think it's a round off to the near hundreds or thousands or lakhs. Latest
Sir,
one.
Yes, sir. But revised Schedule 3 is only applicable for companies, sir.
Yeah, companies. I'm talking about companies. Sorry, I'm talking about company.
Yes.
Yes, we have to prepare both set of accounts. One is detailed, another is in round off, right?
Sir, I would recommend the round off. The value would be very minimal, sir. So I think you can proceed to use the same for your income tax also. The difference will not be too high on both ends. But if you
we have to enclose that statement, right? See, they want detailed. These guys want roundings. Assessee want what we don't know.
Yes, sir. Yes, sir.
So double work this year, right? Companies.
That's the yes, sir. Definitely.
Thank you.
Thank you, sir.
Members, any more questions? So it is a great opportunity when Divya madam is available here. We can take
There is
all
a-
library.
There is a question in the chat box, sir, regarding the turnover and TDS.
Okay, let me just see. As turnover is less than 1 crore during previous year, hence TDS not deducted in current way, even turnover. Sir, turnover is less than 1 crore, TDS not deducted, sir. I not understand the question. If you can unmute and check, sir.
Madam, even I had the same question. I am Ravi Shankar. Are you able to
Yes,
hear?
sir. Yes, sir.
Yeah, it's like even I had the same question, but somebody else also put the same thing. Since your liability to deduct tax at source in case of individual HUF is based on your previous year's turnover.
Yes.
Previous year turnover is more than 1 crore. You need to deduct tax at source in this year, irrespective of your turnover, right?
Yes, sir.
So the question is, previous year turnover was more than 1 crore. I am required to deduct tax at source in this year. That's clear. But the question, previous year it was less than 1 crore, and now it has again reached 2 crores. Did you get it? 3 years, let us say. First year it was more than 1 crore. So the second year he had liability to deduct tax at source. And second, it fell below 1 crore. So in the third year, when again he goes back to 2 crores level, we be liable to deduct tax at source.
So when tax at source is typically on a year-on-year basis, sir. It does not matter what the classification is as a company or as a non-company entity. On a year-on-year basis, when you cross the limit, you deduct tax. If you don't cross, the next year you don't have to deduct, even though the third year it goes back higher.
Yeah.
So that is unrelated to the level that you need to follow for your non-company entities.
And can you repeat something about the 44AD thing? 44AD, it is? You said TDS is applicable or what?
Applicability of section 44AB says at more than 1 crore audit be able. 44AB says, so there is an anomaly in this, but how it is interpreted is we conservatively go with 44AB with a 1 crore limit only, even though 44AD goes with a 2 crore limit. But I'll be happy to give you a detailed written provision for the same after the session, sir.
Okay, thank you.
See, remuneration taken from firm, partnership firm, shall we consider as 44AD or 44ADA?
A lot of firms consider it under 44ADA, sir, where in the partner's hands also you claim that 50%. But recently a Madras High Court decision came which overruled that and said you cannot claim that, because usually the logic behind introducing your 44ADA is you have a lot of expenses, you don't want to maintain books, so 50% you consider. But after, when the firm pays into the hands of the partner, typically as chartered accountants, we don't have that many expenses to render that profession or our service to the firm. So logically, in my view, on a conservative basis, it is better not to take 44ADA and for that further 50%, but it is still under litigation because we have not got a Supreme Court decision, and with the Madras High Court decision, it's still there. So people do continue to take 44ADA in their personal hands also as professionals.
Thank you.
Ma'am, in case of rents paid by an individual, say above 50,000 or above 40,000 like that, do they require to make TDS and make payment?
Sir, if 194I, if I'm right, you need to be a tax audit HSE in order to be claiming your TDS on it. So you do not have to deduct, sir. And up to that limit of 2,40,000, you can take that limit exemption, sir.
No, if the individual who is not, doing business, a salaried employee who is making paying rent of 50,000, do he require to make TDS?
Yearly once we have to. If it is a more than 50,000, we have to deduct.
194I, yes.
194I, 1%.
I mean, if he is paying 6 lakhs per annum of rent, means
Yes,
yes, TDS.
Yes, sir. Yes, sir.
But it is not monthly, yearly once.
Yearly once.
Okay. Okay. If
It
we
doesn't
don't
come under
pay,
194 I, sir, comes under IA. It's a separate
Yeah.
section. That's what
Yeah.
Srinivas Rao sir is saying.
Yes, it is.
if
Yes,
it is
ma'am.
more than 50,000, if it is less than 50,000, no need to make any TDS.
No need.
No,
need.
sir. No, sir.
And I mean, it's 49,999 like that. So I avoid that. Okay, thank you.
Members, any more questions are there? So, Madam, within a short notice that you have accepted our invitation, really wonderful, Madam. We are very grateful to you, and we have deliberated excellently well. And now I request our Secretary, C. Anil Banpal sir, to propose vote of thanks.
Thank you, Chairman. Good evening, dear members. On behalf of the members of Visakhapatnam branch and the managing committee of Visakhapatnam branch of ICAI, it is my pleasant duty to propose the vote of thanks to the speaker of today's evening session, CA Divya Abhishek, for having accepted our invitation in such a short time and for having made such a wonderful and lucid presentation in explaining the issues relating to the audit of non-corporate entities. We thank you, madam, for your wonderful presentation and for having accepted our invitation. Thank you very much. And before I conclude, I would like to remind the members of the branch that tomorrow we are hosting a physical seminar, full-day seminar on income tax issues. And I would request all the members to be present and make the event a successful event. Thank you so much.
Thank you, sir. Thank you so much.
Thank
for
you.
the
Thank you.